If you believe the world is zero sum, then you've missed the point of venture. And I don't know if you're ever going to be a successful venture capitalist if you don't understand the growing the pie bigger approach.
Welcome to the Operate Podcast, where we give you a behind-the-scenes look at company building from the perspective of the builders themselves. This is how we operate.
Welcome to the Operate Podcast. I'm Kerry Ransom. Today's episode is sponsored by BankTech Ventures, the first strategic investment fund designed by the community banking industry for community bank innovation and investment. BankTech identifies leading products and technologies for community banks and works with the founders and management teams to maximize the impact for community banks and their businesses. If you're a bank looking to innovate and invest in the future, or a founder who wants to work with community banks, reach out to BankTech Ventures at banktechventures.com. My guest today is Winter Mead, who is the founder and CEO of Coolwater Capital. And he created this to really create a differentiated way to help emerging managers launch, build, and scale their venture funds. He's been a huge advocate for the next generation of venture fund managers and even built an academy to train them. He cut his teeth in the VC world at some storied firms, Hall Capital and Sapphire Ventures, where he really got exposed to things like micro venture capital, a lot of emerging managers, and even more. We met a few years ago when he was first launching his academy for emerging managers, and I was so impressed in how he thinks about them, about training and supporting them, and his desire to just do something entrepreneurial and different. I know a bunch of his graduates, and several of them are just the best emerging managers that I could think of. And I was super excited to finally record a conversation with him. Winter, thanks for joining me. Super excited.
Gary, thanks so much. Great to be here.
Absolutely. Well, let's start. It's a new year. Always a good time to kind of think about current state of things. How are you thinking about the current state of venture capital? It's been obviously a wild few years. Emerging managers at a point felt great, and now are probably feeling the opposite of great. So as we enter this new year, how are you thinking about life for emerging managers?
Yeah, I'm fairly optimistic, right? But that may just be me. I'm definitely pro-innovation, pro-technology. I think taking a step back, what is the market sentiment, right? And when did it change and what is it now? Going back a couple years now, for me, and again, giving you my perspective, I talked to 1,000+ teams looking to form venture funds every year, right? So every quarter, literally talking to hundreds of teams. And then we run over 200 events in our community per year. So we have a lot of sense of like what is going on. And again, what's the sentiment? What are people thinking? How are people acting and reacting? It felt like the sentiment really started to shift in kind of May-ish 2022, right? And then there's just been a lot of volatility and caution since then, right? And so I think if you remember the conversation, end of 2022, it was like, okay, let's see how this plays out. Things are definitely trending down. This is not 2020, 2021 anymore. 2023 was, I think, people waiting quarter over quarter for things to really shift, especially in the pre-seed and seed stage market, waiting for those prices to come down. And that didn't necessarily happen, right?
Exactly.
A lot of dry powder, a lot of fund proliferation, a lot of folks looking to actively deploy, right? And, if fundraising isn't going well, maybe you turn your attention to doing deals. And so it felt like the pricing didn't necessarily shift over the 2023 market. And now that we're at 2024, right, it feels like the GP sentiment does feel like pricing has softened a little bit. It does feel like there's renewed interest in fundraising for new venture funds, right? We're starting to see some of that sentiment change in early 2024. Hearing that both from LPs as well, where again, like they kind of press pause for 2023, waiting for some of the market dynamics to shake out, waiting for some of these newer fund portfolios to mature a little bit more. So yeah, I think what's the outlook for 2024 feels like, along with my optimism from some other LPs that are looking to actively deploy into venture, Feels like VCs are optimistic at the start of the year. Maybe some budgets are opening up, but they're actively fundraising now. I'd say more actively than 2023, where some people just like wrapped it up, or they put extensions on their funds, right? So they could roll into 2024 by another 3, 6, 9 months. So I kind of saw that playing out in the second half of 2023. But yeah, I think fundraising feels like it's getting a little bit busier. It feels like the volatility of early 2023 has come down a little bit. And so GPs are, yes, focused on navigating their existing portfolios, but also looking at this vast talent market, right? That is a result of the 2022, 2023 market, and finding some like very compelling teams, some very compelling opportunities to invest into at some softened prices. So if you're a GP, I think you're optimistic. If you're an LP, I think you're getting excited about some of these market dynamics.
Great overview. I'm curious, as you think about on the LP side, obviously you spend a lot of time, as you said, with emerging managers and teams looking to form. Are you seeing equivalent growth in what I'll call emerging LPs, not maybe just your historical institutional ones, but newer groups that haven't participated, that maybe recognize these downturn times are usually the greatest time to come in to an asset like this?
I may have a skewed perspective. So just because of how our model works. So taking a step back, what is Coolwater? We're an incubator accelerator that helps find, source, ideate, launch, and scale investment firms, mainly venture firms, right? And so we've built this community. This community has grown quite significantly. So we now have over 200 funds, over 300 founder GPs, over 7,000 companies that they've invested into, right? It's a community that continues to scale. But I think what I'm seeing in terms of fund proliferation is that's kind of like grown very massively over the last 5 to 7 years. And I think you've also seen some of those like find really good companies very early and generate 5 and 10x funds. And therefore, like I think that like the performance of the last 5 or 10 years of the emerging manager camp, and even going back further than that, right, I think is leading to more LPs like coming into the market. So I view the market, I think what we've built with Coolwater, this community of a lot of GPs, a lot of LPs, a lot more transparency in terms of like understanding just what's in the market, how GPs have performed, I think is leading to a lot of new LPs kind of getting excited about the emerging GP class.
Very good. Well, we were talking a little bit about this before. I've been investing in startups for 20 years, both ones that I've been deeply involved with, as well as just others on the side. Mostly while I was operating, I would say I've had some success, but also paid a lot of tuition along the way. How do you help someone determine when or if they should do this as a full-time endeavor?
According to the data in Coolwater, the average fund that comes through our program has made about 10 to 20 investments. It's usually a little bit more, like so over 20 if you're an angel investor, right? So you're honing your thesis, and maybe it's closer to 30 or 40 or even 50 angel investments, right? Where you've kind of gained perspective and you've developed an investment thesis. So from just a pure like number of deals that you've done, like where do GPs usually feel comfortable to start their first fund? Those are usually the numbers that I see. And then I guess you have to ask, like, what are you learning, and like how quickly are you learning that? And is what you're learning actually relevant to being a fund manager, right? So I think there's kind of two perspectives here. One is like, when do you know internally as a GP that you want to become a fund manager? And then you actually have to become the fund manager. So I think that the decision of becoming a fund manager, like, have I paid enough tuition and do I really like doing this, is different than I'm actually going to like train myself now, right? Like, okay, I'm going to make this commitment. I'm going to try to become a professional athlete. How much do you actually have to train to do that? right? I think there's a moment in time where people build conviction in themselves and in kind of like what their career path is going to be. And they really have to love it, right? Like that's what I'm looking for at Coolwater is long-term alignment, right? Not just like, I think the FOMO of being a VC in 2021, it's a very different dynamic than am I going to be a fund manager in today's market in 2024, right? It's a very different, much more conscious choice that GPs seem to be making. But hopefully that gives some numbers to like what tuition am I actually paying?
How do you think you kind of was starting down that path? I mean, it is one of those like super glamorized jobs, if you will. I'm not fully convinced people understand the full scope of the actual work, right? I mean, being an angel versus raising and managing an institutional fund are fairly different as far as just the type of work, whether it's not that dissimilar in my mind from being a startup founder to being in scale growth optimization mode, that the actual work you do starts to change. Do you think people have a fair understanding of that? Or do you think you kind of see a good number who don't realize it until they're doing it?
Probably the latter. Feels like a lot of emerging managers don't realize the full scope of work, but that's probably similar with a startup as well, right?
Oh, for sure.
And
Yeah.
so you almost ignorance is bliss. You kind of want right some of that ambition, and if you're curious enough, and like I said, you've kind of made the decision, and I'm going to commit a number of years to launching this, and even more years to perfecting it. I think that's kind of the mentality and the personality you need to be successful. But yeah, I think hands down, most emerging managers underestimate what this job actually is, and Coolwater tries to actually help managers understand that, right, before they become managers, right? Because once you take other people's money and you're managing as a fiduciary, like it's kind of a different game than if you're an angel, right? And so like investing with your own money, like there's a lot more responsibility, and like you said, the scale growth optimization, like there are other things you have to think about on the operation side, on the management side, organizational growth, right? It's not all just about finding the next hottest deal, but there's a lot of fund management that goes into building the business now. And I think there has to be a passion for both operating as well as investing, right? At the beginning, that decision we were talking about becoming a fund manager, like has to begin with you loving investing and wanting to do this as a career, right? And finding that the intellectual challenge. But then you also have to love the operating piece, or at least be good at organizational growth where you can like hire to solve that for you, right? And know kind of what you're hiring for. But yeah, that scaling, that optimization, those phases, those pieces of the puzzle, like are absolutely necessary. Again, you can get away with it the way, the Coolwater perspective is you can get away with some of it, even though we're very institutionally biased, like you can get away with some of that at Fund One, right? Like you don't need to build the Rolls Royce at Fund One. But if you want to scale and graduate from Fund One to Fund Two, yes, LPs will be focused on performance, but they'll also be focused on what you're actually building as an institution and as a business. And so the Coolwater approach is, right, kind of a pre-fund manager perspective, a fund manager perspective, and a scaling a fund manager perspective, right? Where the pre-fund manager is do what you want to do. Do you want to do this long term? The fund manager perspective is, hey, you got to start building this as a seed stage startup. You got to put in some business processes, right? Like you don't have to build everything now, but you are becoming a business, especially as you start to build out your portfolio, right? And then it becomes harder to manage that portfolio. And there's just a lot more you're doing in terms of portfolio management that you didn't have to do at, day zero. And then there's the fund manager kind of scale process, which is, okay, great. I've built out this first portfolio. I've got, 20, 30, 40 assets in the portfolio. I need to build something real here if I'm going to raise my next fund. And this is going to become like, a bigger business. with larger amounts of portfolio management on the day to day, right? And like, what are you actually building here? So I think that in part is like you loving operating a little bit, right? But it's also probably making the decision at some point in those, three phases, pre-manager, manager, manager at scale, of, what type of manager do you want to be and what type of business do you want to build? And, within, the building a fund manager career, like there are different permutations, right? Like you can do it as a solo GP. It's hard. It's hard, even harder to scale as a sole GP, but you could do it that way and emphasize picking versus value add, or, you could do it with more people, right? And so emphasize kind of picking, obviously, but value add as well. So more people at the firm. And I think there's different ways to build a venture firm. And again, these are different decisions you don't have to always make on day one.
As you look back across, the history of folks that you've worked with and maybe some of the newer emerging managers, are you seeing any differences in the latest generation of emerging managers versus prior era, or are there some common characteristics that you think consistently exist?
Yeah, really, really good question. I would say in 2023, given it was a tougher fundraising market, and that, again, the cost of capital had gone up, the person that was more biased to start a venture firm had more operational background than not, right? And I would even say, I'm generalizing here, that there were more prior founders, right? So they'd already demonstrated that behavior of founding something else. And, the founder mentality is a very unique mentality. And so I did see that kind of in what had people done before and were they willing to do it in 2023. It felt like those focused on fund formation, especially de novo, starting a new firm, did have more operating and founder experience than, the 2020, 2021 crowd, where again, it was the fundraising market was different. And I'd argue there were many more people from many different backgrounds, not just founder and operator background, kind of getting into the business.
And do you think that founder background is one of the most critical or higher probability of success backgrounds for an emerging fund investor versus not?
Not necessarily, right? Like there are different ways to get into business. So I almost think in venture, success begets success. So if if you don't have that founder or operator background, but you've been very successful with your early track record, right? Like you can spin that into a successful platform. Obviously requires some management, requires some skill, requires some focus. But I think that's, one way to get into the business. That's not necessarily you being a founder. I think, personality wise, like maybe you have a founder personality, but you haven't necessarily, been a founder in the past, but you have that grit to kind of keep pushing forward and just be relentless in the first fund, right? To get it off the ground. And then again, success can beget success on that front. So I've seen that. I've seen it where there's kind of like an aura, like depending on like the background of where you worked, the company, like the market perception of the company or the market perception of the investment firm that you're coming out of, right? Like again, not necessarily a founder, but very well trained, really sophisticated perspective, really understand the VC model, either from like the VC growth perspective or the VC investing perspective. Those people tend to be pretty successful. I would argue it's more those people like in a camp of their own that probably raise the most amount of money, right? Because like institutions have already seen them either in their portfolio already, either on the company side or the VC firm side. I'd say those people raise the most amount of money to start, and you can kick off with a $50, $100, $200 million fund if you're already a known entity in the ecosystem. And again, like, are they founders? Yes, because they're starting their own firm. I would argue there's still operating risk there, right? Because they haven't started something in the past, and it's going to be a very different exercise of now like running their own business versus like if you've run your own business in the past, like there's a lot of stuff that, you know, you wouldn't be used to doing that you now have to get used to doing. So I think there be like more challenges on like the scaling and the growth and even thinking through like what it means to optimize because you're becoming kind of a founder for the first time. But yeah, those GPs are definitely out there. And I don't think it necessarily just has to be you founded something in the past and now you're going to decide to found a VC firm. There's different ways I think to get into the business. There's more archetypes than what I just mentioned there, but those are a few.
That makes a ton of sense. I'm curious, as you think about either what you would recommend or what you've seen as an early fund. So you're in your first fund in the first few years of your first fund. Are there any things that if you can see that happen in those early years sort of sets you up at a big advantage for subsequent, like an early exit or liquidity or markup or something in your early portfolio? Like, because the feedback loop and the signal in some cases can take a long time, which is always one of the challenges, I think, for early managers.
Yeah. I mean, there's a few things here. Again, probably a more exhaustive list, but trying to get early follow-on rounds, right? To demonstrate that there's third-party validation in your portfolio. So that's definitely something to try to focus on. And again, a lot of this stuff comes down to portfolio management, strangely, right? Because when you're an emerging manager, you're thinking about fundraising, you're thinking about doing deals. You're not necessarily thinking about portfolio management, like managing the deals you've done. But like, you know, what is my next deal? How does that kind of flow into my fundraising process? But I do think there, you know, to your question, like some of the answers to that question are actually more on the, you know, portfolio management side. Yeah, trying to get follow rounds, early exits, definitely. Generating liquidity early never hurts.
Yep.
I think showing traction, again, it's usually third-party validation of like a markup that, you know, for better or for worse, demonstrates more traction than traction itself, meaning like actual revenue growth. Because I think it's just harder for the LP to see that if you're trying to, you know, scale up your firm. But again, knowing how to present that information, again, something we focus on at Coolwater is like helping you build the internal reporting. Like, what do LPs actually care about? Like, you know, what data should you be capturing? What data should you be sharing? How should you share it? You know, how should you present it so it's digestible? Things like that. You know, all of that. I think if you spend time, which sometimes, you know, maybe again, like you'd rather be spending it fundraising or doing your next deal, but if you sometimes spend time, you know, on the business instead of in the business, like that can be helpful. Like we run part of the academy, we run a back office program called Strategic CFO, where we actually build out your back office and help you think through some of this, like how would you actually build some of these reports to share it with LPs, right? I think that's a really important thing. Like if you do that early, and LPs actually know what you're building and how things are going, whether you've knocked it out of the park or just like had some traction, the fact that they know you're doing what you said you're going to do and there's some traction is better than you saying like, you know, look at it's 2 years and I have a 10x fund. Like, right. It's more like every quarter, look at everything I'm doing. Right. And they can kind of track it, invest in lines, not dots approach. I think that's kind of really, really important and maybe a little bit nuanced of an answer, but pretty important. And then, yeah, like other things like who you bring on, right? The 1 + 1 = 3, you know, that's pretty important. You know, I mentioned solo GPs, like you can scale as a solo GP, but I think in this market, I would say LPs care more about, you know, more robust organizational growth. So who you bring on is pretty important. And then, yeah, other things which are just harder to accelerate to make a success story around, but, you know, concepts like vintage diversification, right? Where, you know, you're sitting around twiddling your thumbs, but you know, if you've invested into some good companies, fast forward 2 years, 3 years, you know, you've done your vintage diversification in the portfolio, like that can actually, you know, be a competitive advantage, right? Where we had a time a couple of years ago where funds were coming back every year,
Mm-hmm.
again, because the cost of capital was less. And there were a lot of folks chasing yield in early stage capital markets. But now that that market cycle has receded a bit, right? Like there's other kind of these more traditional concepts that if you think about are relevant when trying to scale and trying to become successful.
Oh, super valuable insights there. That's awesome. Let's talk a little bit about just VC as a asset class and structure. I mean, there's been a lot of data showing concentration of capital amongst a fewer number of firms with significance. And, I feel like the startup market tends to adjust and adapt to the capital swings, business models, and things that are shifting. I'm not sure I buy that VC makes those shifts as certainly not as quickly. And I'm wondering if you think they should be. Like, do you think as the underlying startup market shift, should VCs be quickly shifting as well? And if it should change, how do you think it needs to change for this next season?
So your question's around like if we start talking about Gen AI, then everyone needs a Gen AI investment strategy.
I mean, should they,
could it be
yeah, should they
thematic
be adapting or even just their model of, funds? If you had a $1 billion seed Series A fund, and now the market's gone back to demanding more capital efficient startups, should they shrink the size or adjust in some way?
Yeah, I feel like there's a few questions in there, but
Oh,
yeah,
I got tons.
like how do you a couple ways to think about it maybe is why did firms scale up in the first place?
Mm-hmm.
Candidly, it does feel like the cost of capital was a big player there, and being opportunistic in that type of market, which has led to a lot of scale, but it's also some of the actual VC market dynamics of companies were raising more, right? They're staying private for longer. It was more competitive, so it required more dollars to compete. One of the biggest expenses, like the cost of labor and talent, went up, right? So fundamentally, like there are a lot of kind of things playing to larger rounds, more dollars needed to be invested, and just the way portfolio construction math works, right? Like the need to buy equivalent ownership at larger prices, which also meant kind of larger rounds. So a bunch of dynamics at play that kind of led to larger and larger fund sizes. Again, I think there's definitely if you're ambitious, curious person trying to build a firm, right? The inevitable path is scale AUM, right? But I think some of the best performing investors of all time have embraced this idea of patience and understanding, what is the tier one opportunity set that I can invest into at any point in time? Like, what is my actual investment market size? Is it $10 million a year into this part, like to like actually generate outperformance, or is it $1 billion a year to generate outperformance? I mean, there's other factors like the LPs that are investing into that, like what returns do they want? Do they want a 10% IRR, or do they want a 10x fund over 10 years? So it kind of depends, like where's the money coming from, and what is the macro market doing, what is the micro kind of market doing within VC. There's a lot of kind of dynamics that I think smarter money managers are thinking through to really assess, like, do I scale up? Should I scale up? And if I scale up, like how does that change my strategy? And so, consistently, Coolwater being, very focused on early stage, what we see is, success begets success. You raise 5, then 15, then 25, 50, then 100, and you've moved into become a potentially Series A firm, and you moved away from being, initially when you started, a pre-seed firm. So again, there's always going to be emerging managers. That kind of opens up the market to a new pre-seed entrant, right? So, and then I think your question on, so I think that dynamic will continually play out. Like as long as you have successful managers, most, right, like 98% of them will scale up AUM. It's really the exceptions that choose to keep the same strategy, right? But I would challenge the market and like challenge the listeners. Like if you're a fund manager, like why would you go from 10 to 20? Right? Like, are you going to be able to generate the same performance by going to 10 to 20? And is that the right thing to do? And I do think if you're thinking about it from the LP perspective, you know, does this fit the strategy? Does this change the strategy? Does this change the portfolio construction? Does this change the ability to generate outperformance if you scale?
And it may not be
Yeah, I
as
think
profound, like 10 to 20 may not be as profound of a difference as 200 to 400 million, for example, right? Like the
Yeah.
challenges may get way
Totally.
more pronounced as you get farther down that.
Yeah, and I think what I've seen is there's definitely, to your original question, like, you know, billion-dollar fund sizes, are they coming back down? I have seen, and I think there's some, you know, stories in the media as well, as some bigger funds haircutting, right? I haven't seen, and maybe this is just because I just haven't seen it, but I haven't seen a lot of funds giving back money, saying like, hey, I don't actually think I can return a 5x fund with this much capital. Maybe that's happening. I have not seen it. I had seen it in the past, like, yeah, I feel like 15 years ago, but I've not seen it yet in this market. But yeah, if people are seeing it out there, you know, feel free to reach out. Curious to hear what and how that's happening. But should they shrink the fund size? Like my perspective is, yeah, it's not up to me. It's up to them. But if the responsibility is like making, you know, returns for your LPs, asking yourself what's the right opportunity set and fund size to address that opportunity set is a really important thing to think through. And I'd argue, yeah, like, you know, if you're raising a AI fund in 2023, how competitive is this market? How big does your fund size need to be competitive, right? And even if you're competitive and you're buying in, like, are the market dynamics so out of whack where pricing is so high that you might not actually be able to return, you know, an outperformance fund to your LPs at the end of the day. So again, there's a lot of things you have to think about. Yeah, I feel like I addressed some of them in that response, but not all of them. I feel like there's a lot of things you have to think about as a managing GP and deciding like, yeah, just how big your fund should be at any point in time. And especially if you've gone up, really hard to kind of like, you know, march back down. Like once you've changed your lifestyle, right, to a certain lifestyle, are you willing to kind of like sacrifice and give up stuff, right, to kind of reset? In my experience, a lot of people are unwilling to do that, even if it's the right thing to do.
Almost universally true. That's right. I'm one of the few people I know who has actively taken 50% pay cuts or more multiple times in my career because I felt like the opportunity on the other side was worth it, right? But that's a rare. I'm probably crazy because of that. But yeah, I totally agree with you. And it's not just the GP, right? In some cases, they've got an infrastructure that has a fairly high fixed cost that they want to perpetuate as well. So it's an interesting question for sure. I'm curious though, do you think VC is a scale business? I have contemplated for a long time. I'm not sure I believe it is. I mean, obviously, as some of the institutional LPs have gotten so massive, their minimum check sizes have gotten so big that they can only take a certain percentage of a fund, and you got to be big enough to be in that game for them in some cases, right? So I would even say some cases they've driven some of that behavior. But I'm curious, like, do you think this thing can drive value at scale?
Potentially. I mean, I think you have to buy into the assumption that, you know, you're trying to do a few things, right? Like if you raise so much capital for a big fund, how do you return it, right? Like if you raise a lot of money, you have to write big checks. If you're writing big checks, you're going to be investing for the most part mid to later stage, and it's harder to buy significant ownership, right? And then again, like what is your return profile? Like what hurdle are you trying to reach for a return, right? Is it a 2x? It's probably very different if you're a much larger fund, right? And so I view there's like a difference between VC capital and growth capital.
For sure.
Right? And
that's why I call it specifically VC. Yeah.
Yeah, but I even say like a lot of the VCs in the market of the last few years have become more like focused on growth investing
For sure.
than VC investing. And I even see it like playing an early stage where, there's certain risk you're taking around team and business and market and product, whereas some early stage VCs won't take those types of risk, right? Like the product already has a lot of proof points. The market is pretty baked, right? Like it's kind of obvious. Like if you're able to kind of like dial in the product right, the business is already like fairly developed. Like the team is like pretty developed. Like there are VCs that'll mitigate those risks. There are VCs that'll like, really take a lot of risk across those different vectors. And then, I think if you scale up, you're effectively providing growth capital. Like you're not necessarily providing VC capital. Like it's a business that's trying to really scale, right? Like these, unicorn plus companies that are taking billions of dollars, like they're really trying to achieve like universal scale, right? And if you think of like what are the upper bounds of the market, right? Like the end game is public markets, probably in the US, like trying to be like, the 100 billion plus, up to $1 trillion company. Like that's the end game for a few exceptional companies. And so if that's the company you're trying to invest into, right? And I started to hear this like, quote like 10 plus years ago, where I think as soon as, or maybe it was less than that, maybe like 6 years ago, but as soon as maybe it was Apple, the first company to like hit $1 trillion, right? As soon as you hit that market cap, it was like the name of the game was, okay, what's the next $1 trillion business we're going to invest into, right? And so if you move the scale, right, like if the upper bound changes, which it has, then it's kind of saying like, hey, you can actually 10x a $100 billion company, which is crazy to think about, right? Like, and then I do think it was the entrance of SoftBank that kind of also changed people's perspective as well, where, right, like the largest VC fund up until SoftBank, I think was only $2 billion, right? And so they changed the perception of scale as well. And then you had some of these very great success stories that, have come to market and have scaled either mainly in the public markets, that I think has allowed people to be playing like a different game. But I don't think it's the VC game anymore if you raise that much money. I think you're playing a different game, and it's more on like the hyper scale, but growth investing, where there's hopefully a lot of mitigated risks that you wouldn't necessarily have to take if you were, if you're a VC investing, you would be taking those, right? Because you're trying to get the 100x, 1000x outcome. But now as a growth investor, you're kind of saying like, hey, maybe I put some structure in here. There's some downside protection. It's a different investment you're making with different structure, but you're playing fundamentally a different game, looking for much larger outcomes. And there's how many unicorn companies that have kind of raised at that valuation, like 1,500,
there's a lot,
2,000. Yep. There's a lot. So that, right, like, and you have healthcare investors that raise funds that are investing into like a subset of like 100 funds that are publicly listed. Like that's their whole universe. And now it's like you can have like a strategy that applies to a universe of a couple thousand companies that are like very valuable. Can some of those 10x from here? Maybe, but it's not venture investing in my mind. It's a different structure. It's probably more akin to growth than venture.
Yeah, I agree. It's a like focused growth, or maybe there's a new emergent, host venture hyper growth definition or something that comes up in the next few years. No, great. I think a great tour of that from your perspective. So I appreciate that. How about compensation? Do you think compensation for venture and venture firms needs to adjust at all?
I think this is one of the most nuanced topics with respect to fund management, where a lot of the times it does feel like the founders of a firm, this isn't the right way to frame it, but care less about the compensation and more about like the ultimate outcome, right? Maybe that's because they're such large owners of the firm, where, there's different ways to think about compensation. Compensation in terms of salary is much less important to the founder VCs I'm talking to, right? And once you're deep enough, I think, into the game, like you care a lot more about carry and success of building, a long-term oriented firm, successful firm. But yeah, if you start bringing in other people, like the way their compensation is structured is definitely going to affect their behavior. And as much as we like to think everyone's going to be 100% founder line, that's just not, from my experience, how it plays out, right? It really is, the incentives, right? Show me the incentive, I'll show you the outcome. Like it really is the incentives you kind of implement in the early days can potentially affect what firm you ultimately build. So again, I say it, there's a lot of ways we could take this conversation, but it's a very nuanced topic from what I've seen. And, these conversations are usually taking place behind closed doors, and there's not a lot of, public data around, numbers, absolute numbers, and how these structures play out. And, it's almost like these structures can be dime a dozen. There's just so many of them. And, what's the right one? I think this is a very idiosyncratic thing per firm, right? I think it's one of the hardest things to figure out. And especially if you're starting out solo and growing from there, right? I've seen people that have kind of fully cut the person in, but other people, right, they have a hard time going from solo to the second partner. And so they kind of have a grow from within approach, right? They just like, it takes longer for them to build perspective on who do they want in the business. But yeah, it's really fascinating topic.
Well, I think it also affects how they work with their founders and portfolio companies to some extent, because if you really subscribe to power law as an example, I think you see cases where people just abandon those founders that are clearly not going to meaningfully contribute. If they're not that company for the fund, then is it binary in how they treat them, as an example? And I think there's been some evidence that's shown that even if you can get more of the other ones to positive outcomes, that has real meaningful ultimate impact, but that still requires time and effort allocation. And so those are the places where I find it really interesting too. And to your point on what are the behaviors that are being encouraged and reinforced, that may or may not all be just comp based, right? Could also be brand and reputation.
Yeah, I don't know if there's a big enough conversation about like how do they do it in the real estate world, or how do they do it in other asset classes? Like what does alignment look like there? Like actual alignment and reinvesting into the business and reinvesting into your outcomes. Like how much conviction do you have if you're a founder VC and you're investing 1% into the fund, right? Like, is that true alignment, right? That doesn't feel like, you have actual skin in the game, right? So, I mean, if you just look at the financial models of how VC works, 1% is not significant in terms of the numbers we're talking about and how the cash flows, right? So, but the market is the market, right? It's kind of, can one person set the market price? No, there's thousands of operators out there, and there's decades of tradition of like how the market actually works. But yeah, I think if you want to differentiate, right, and kind of say, hey, look at me, right? Like I am demonstrating a different type of alignment, and your behavior is different. Like that could be a positive thing for LPs. And yeah, if you're talking about founder VC dynamics, like that can be a positive thing for, that relationship as well, where, if you're driving the Lamborghini into the parking lot of a board meeting, right, that might be kind of a tough pill to swallow for people that are, working for equity and upside.
Yeah, I've seen that where I've been able to talk to founders where I say, look, like we're a considerable percentage of our fund personally. So this is my money in your company. So you can understand why I'm so interested in what's going on here beyond just the fact that we want to try to help you.
It's something I think about a lot. Like have emerging managers really put their own money to work? It's a very different feeling than investing someone else's money, right? Like there is no house money, it's your money.
That's right.
And how do you feel when you invest it? Right? Like this isn't a bet anymore. Like this is like your lifestyle that's at stake. And so I think I don't know if a lot of people have that perspective in the recent market, right? Again, like if money is cheap, right? And the market dynamics change so that you're actually less aligned with the VC structure. Like, if they commit less capital and management fees go up, right? That's kind of a divergence and I actually think it's a healthy thing to really know what it means to be like an angel investor, to put your own money to work, or if you're a fund manager to write those GP commitment checks. Like that's meaningful. Like, and then I think it changes your perspective on how you invest. I think it's a very positive thing for the market. And, I think some of that behavior over the last 10 years has diverged, and you haven't even had to put up any capital to like form an SPV or to invest kind of into these opportunities. And the reality is venture is very risky, right? And so you kind of want to make sure you're aligned with the outcome and high confidence in the outcome. And I think you can affect and improve the decision-making process if you write your own money into deals.
Totally. Well, let's talk a little bit about Coolwater. You kind of, at least briefly described it earlier, but I'm curious why you decided to do it.
I started investing at a multifamily office that also managed capital on behalf of endowments and foundations, and kind of learned the ropes there of like what it meant to be an LP. And then I moved over and had a really special experience investing, but also building. So it felt like the role of an entrepreneur. And, the building part gave me perspective that, to build a fund was more than just investing. Like there are these other parts of it. And we were investing into VC funds, and we were even investing into first-time VC funds. And I was playing a role of helping those funds understand different things as they built their fund ones. And I was gaining perspective on the fact that there were different functions with respect to building a firm, right? Like there's the management company, there's the fund, then you raise multiple funds. And again, like there's different things you're doing. You're not just investing, you're managing the business, you're building out the operations, you're hiring, you're performing diligence, you're building a value-added function. There's all these things now that you had to do. And for me, like I wanted to play coach, right? Like I actually wanted to try to like, what does add value mean? Right? It's a very diluted term. And so for me, it was like, how do I understand the different perspectives, right? Like I've invested into over 105 funds in the last 13 years, and I've helped launch 200 funds like through Coolwater. And so the perspective wasn't like, I know better than you, but it's, do I know different perspectives, right? So if you're going to be the equivalent of a board member for a fund one and help someone really understand the different functions involved, but also what have other people done successfully or unsuccessfully, and can I actually train that and help people like get up to speed faster? That was kind of the idea behind an incubator accelerator program. Again, I'd done that a number of years as an institutional LP, and then I did it 3 years as a consultant, like helping different firms kind of understand, what their strategic positioning should be, what their back office setup should be, how they should pull together their track record and narrative, how they should think about their, quote unquote, go to market. And so all those things I thought were relevant to the fact where, if you're the founder of a VC firm, you're becoming, the CEO in training of your VC firm. And so like, could you coach CEOs to be better CEOs? Could you coach founders to run their businesses better? I think that was the core concept. And then from there, the extrapolation was like, okay, if you can do it successfully with a couple of people, can you do it at scale? And I think that was a key concept that changed, okay, I can do it, with 2 people on a consulting basis, but can I do it with 20 people on a cohort basis? And will it be a better experience, which is really important, right? Will it dilute the experience or will it enhance the experience?
Mm-hmm.
And what I noticed, asking a bunch of friends basically to do the first cohort, kind of saying like, hey, just believe it. This is going to be a crazy thing, but no one's ever done this, but like, just do it, right?
Mm-hmm.
And just trust the process. And again, like the enhancing the experience was like very clear. Like the outcomes were better, right? And again, I think a lot of VCs invest on the back of a network effects thesis, right? Of, you play the game of telephone. It's like the more people in the network, the better, right? The more powerful it becomes. And so while the idea was like, okay, can you scale consulting and scale coaching, right? Like ultimately that leads to managing a community and managing the network effects across that community. That becomes the more interesting dynamic ultimately, versus like, I'm going to train this person and teach them something. It's like, great, but really these are all just exceptionally smart people, right? Building like the next generation firms of tomorrow. So you're right, like you're just kind of keeping the wheels on the track at that point. And like, again, that's managing the community now and enabling the community more so than teaching like one specific thing, right? That's incremental. It makes someone like incrementally smarter.
As the community's grown, are your metrics of success, value creation, are those staying consistent or are they changing?
That's such a good question. Yeah, so there's a few KPIs, right? Like we had 100% success rate in cohorts 1, 2, 3. Every single fund that came through our program got into business successfully.
That's huge.
And most of them exceeded their targets. So we were clearly doing something on the picking side. But again, like, who cares? We're not taking enough risk, right? If you're like, hey, I never lost money in a deal, it's right. You're like,
right.
okay,
that's right.
Well,
I think that same way, like you do there. That's not how everybody thinks.
Like
but,
maybe you left a lot of money on the table. It's like, great, you 2x'd your portfolio and you never lost money, but like, right, like that, it felt like, okay, great. Maybe we're a private equity strategy versus like a VC strategy if like we're not losing money in any deals. So I think the idea was, okay, how do you take more risk? The other element was like this idea of actually creating something different in the early stage VC ecosystem, actually different, like a differentiated platform, not another fund of funds, but a unique differentiated platform, right? Where anyone in the world who's an aspiring GP could come to Coolwater and run through that journey, fund 0 through fund 5, whatever the number is, until you're off to the races and you need no one's help ever again. But who is the platform globally that does that? Right. And so for us, like, it's about getting folks who are very helpful to founders, who are going to be net accretive to the venture ecosystem. We're trying to get those people into business and help those people, right? That's the curation that's happening. Good investors, great investors, they're going to generate returns for their LPs, but they're going to do that in a way that's, again, net accretive to the venture ecosystem holistically. And like, these are people that are net positive to be on the cap table and to help founders, right? Like, that is definitely an initial screen. But yeah, the way the business is managed, I don't know if the KPIs necessarily changed, but the way the business is managed, it means like I said, it's kind of going from more of a educational center and academy to, generating more engagement, managing it more like a community, making sure that, as it scales, and we have now folks that have graduated years ago that have been very successful, raised lots of money, are onto their N+1, N+2 funds, like, right, like generating that kind of give back culture and attitude, right? That's I think how it's evolving. I don't know if the KPIs necessarily change. Like, we want to help every single best next generation fund that's launching in the whole world every year. Like, we want them to come through Coolwater, right? Like that would be, the success story. But it's, that KPI really doesn't change. Every year we want to meet with the best new funds and like work with them and help them get off the ground. But I think the way the business is managed has changed, like, fundamentally.
Thanks for sharing. I'm curious, when you meet a first time, see whether it was some of the folks that came through your cohort or you've met through the process, are there any things that you've consistently seen that you either say, wow, they're going to be great at this, or the other side where you go, ooh, they're really going to struggle, I think?
There's probably two quick answers to the are they going to be great. One, right, having again meeting with 1,000+ funds a year, having invested into 100+, over the last decade plus, like there's kind of a screen you get as an LP where you know it's going to resonate with other allocators. So I think that, and that screen is a combination of, right, like the team, the strategy, the track record, kind of, what the person is actually building. There's a lot of kind of quick check boxes where you can be like, okay, this seems really interesting, right? It passes the, interesting screen. The other piece is just like the personality of the person, right? Like how much do they want it? And like how much do they understand that this is going to be a fundraising job, right, for the next 2 years versus an investing job. And so yeah, some of it comes down to like understanding, their background, but also their perspective and motivation to get the fund off the ground. I think, yeah, they don't necessarily, hit on some of those markers that are, kind of table stakes in this market for getting LPs to lean in and get excited. Like where do people struggle? Probably if they, in this market, right, not necessarily in a 2021 market, but if they do it too soon, right? Like if they are too impatient, or you could get away with that, I think 2-3 years ago, it's harder to get away with that today. If you're starting too soon, but you gotta start somewhere at the same time. I think it's really tough where some folks come to me and they've never made an investment. And so we actually have a way to kind of help them. Again, if they can still be helpful to the VC ecosystem and helpful to founders, even if they've never made an investment. So we've kind of built this other program that helps them plug into just, those first few investments with our community. But again, like that's going to be a struggle where they might have the best idea in the world, but if they don't have the ability to, execute on that idea because they don't have the past experience, that's really tough. And the other thing there is I usually ask people that come in with no track record to like really just ask themselves internally, like, do you want to be an investor, right? If you've never made an investment before and you're telling yourself, do you want to be an investor? Like, are you lying to yourself, right? Or maybe you're not, but you just don't know yet. Right. So I think you have to make a few investments to really understand, do you really like it? Like, do you like the intellectual exercise, like the risk-taking exercise, right? The portfolio construction exercise. Like, do you like that type of stuff? The answer might be no. So that's kind of a struggle.
Or they don't know yet. Yeah, to your point.
Yeah. If I meet people along those lines.
Super helpful perspective. Well, in the last few minutes we have, certainly would love to just go a little deeper on you, Winter. What was it that sort of initially got you interested in this ecosystem at all, as far as startups, investing in them, this venture asset class? What was it that drew you to it initially?
I think I've always had an affinity towards business and being an entrepreneur. Like most people, maybe not like most people, but like most people, had a pumpkin stand growing up, right? So it kind of, and the thing about a farm stand is like it takes some patience, right? You can't just like mix the lemonade necessarily and sell it the same day. Like you have to wait 6 months and like nurture the fields. And then like, so there's some like patience of like nurturing a portfolio. So just early on, definitely more entrepreneurially leaning. And then, yeah, venture, it was from a professor at Oxford, I'd say, that gave me the advice, where I was studying innovation largely, but it's his advice to move to the Bay Area, right? He's like, hey, if you want to really go deep on venture and innovation and
That's
technology,
yeah,
this is the place you at least want to spend some, if not a lot of time in. And so, looking back, that definitely was a pivotal moment. And then you kind of, being there, right? Like the Bay Area has a certain culture of, and you can still find these people of risk-seeking behavior and selflessness and trying to grow the pie bigger, right? I think being around that mentality is very important at some point, like especially earlier in your career.
Yeah. And it's not universal. I mean, I think you know this, like that is not a universally held view globally, and even in other parts of the US, it's not. Yeah.
No. And if you believe the world is zero sum, then you've missed the point of venture.
That's right.
And I don't know if you're ever going to be a successful venture capitalist if you don't understand the growing the pie bigger approach. And I think that's a very important fundamental concept that feels exceptional in certain places, the Bay Area included.
So powerful and such good advice, I think, for anyone. I mean, I think whether you're going to end up in venture, just being able to see that the world is positive sum and abundant is such a useful learning as early as possible. I feel like I find that, people that are as successful as you have certain disciplines or rituals that they've found really help them. Any of those that you have?
Rituals I do on a daily basis, or what?
Regularly, or just certain disciplines you kind of hold yourself accountable to?
Does working 20 hours a day count as a discipline? I feel like growing up on a
hard,
farm,
just having a hard work ethic, I think, is absolutely.
I think growing up on a farm teaches you a work ethic
That's
that
right.
most people don't appreciate. You have to wake up at 4 a.m. to thaw the pipes so the cows can drink water in the middle of winter so they don't die and your family can persist another year. I think, there's their perspective of like that work ethic, but daily rituals, no, I think it comes down to more work ethic. Like I like the space of either walking or running or biking or skiing and thinking, right? Like having some space to think where, it's good to run super hard. But again, this is the idea of thinking on the business versus in the business, right? And I think this might be more true for, again, like CEOs or founders or folks that are managing, but taking some space to think strategically pretty like consistently, right? It doesn't have to be every day necessarily as a ritual, but maybe it's monthly or quarterly or even yearly. But like the idea to say like, is this working? And do I have the power to change it, right? And having the perspective of some things you're powerless towards, you just can't control as much as you like to think you can, right? Like I am not on the investment committee of thousands of LPs, right? But can you influence how someone understands a fund product and a strategy, right? Or like there's certain business decisions you can make that feel irreversible, and there's some you can make that are definitely reversible. And I think like rituals to me, like, strategically can be that, right? And so I'm very much a big believer in like, trying to consistently, evolve myself and like, make progress personally as well as professionally. And so I think like you have to force yourself into these like thinking habits that, again, like that's more kind of strategic and business oriented. But I think it also is like, for mental health, like it's like a good thing to have rituals where like you feel like you're in a safe space. Because
absolutely,
again, like the business is like, it's so hard. It's like something like that isn't necessarily always talked about is like how hard business actually is. Like for people that are running, like trying to truly make an impact and running 1,000 miles an hour every day. But again, like I think the rituals for me sometimes like, okay, let me detach a little bit and have that moment to reflect and think. Like that's kind of how I use my rituals. And I think that's helpful for me, at least, to give me a little bit of space, at least 4 hours a day of space. I can work the other.
Well, what I'm hearing there too that I so appreciate is it also helps, that term detach is so useful because I find far too often, particularly with founder entrepreneurs, that they wrap their entire identity in this startup or this company. And we're all more than that one thing. We need to be passionately driven, committed, and in it, but we're all more than that. And I think that is healthy, just even to create that space. Like, I need to not just be in it, but also continue to think on it, work on it from outside. So I think it's very useful that what you're doing, and great advice for others.
Yeah, it's interesting how perspective changes when like you go through a traumatic experience. And I think starting a startup or a company
is traumatic,
and is, just starting is traumatic, but yeah, like going through it a couple times. And I think that's when people like refer to grit and resilience. It's like, at some point you love it so much, you just keep pushing forward, right? No matter how many times you get knocked down. And like you said in the beginning, right? Just the persistence over time, like being around for long enough and building experience that way. It does add up in VC, even if it feels like at a snail's pace.
No, I totally agree. Survive long enough to have the right timing and luck and good decision making all line up at least enough
but
times.
VC is so funny, right? Like the people I met in like your question on, who's the best. It's like, I feel like those people are so impatient, but they're so patient at the same time, right? Like every day is like, I need to get all this done, right? But at the same time, like they're in VC. And so success comes over longer cycles.
That's right.
And, they've done thousands and thousands and thousands of cycles by the time like they see an outcome. I feel like the people that internalize that's going to be part of the process. Like, you don't see it overnight, you don't see it in a year, but fast forward a couple of years, like those are the people that seem to be building like big companies and interesting firms.
Such great perspective. Well, last question, as you think ahead for you, what are you most excited about for Coolwater this year? And I know you've got some other things on your plate, like I heard rumblings of another book. So curious what you're most excited about this year.
So looking to launch, or I guess publish the second book, how to set up a venture capital fund. We've built the strategic CFO program, which is focused on building back offices. We think that's going to be a really important theme for emerging managers, especially if you want to go from fund 1 to fund 2 or fund 2 to fund 3. Like, have you built the business to pass operational due diligence? So the book is kind of in line with that new program. I'm excited about that program, as as fascinating or as boring as it sounds. But I do think that's a really, like, as the market shifts a little bit, harder to fundraise, table stakes are up. Again, like who's the platform that's like helping emerging managers kind of get to the next step? And I really believe in the emerging manager story and the importance of emerging managers for early stage VC and VC generally. So I'm excited about that. And we're also doing more of these salon events, name subject to change, but these events where we're like basically now with a big enough community going really deep on themes and technology and really helping LPs get more connected into the world of early stage venture and kind of really understanding what they're investing into. We did roughly 25 of those events last year in 2023 and expect a similar number this year. But I think are there LPs that are excited about venture? Our view is yes. We want them to be, again, like as smart as we can make them through a community approach to make wise decisions allocating into early stage venture. So excited about those two things for 2024.
Winter, thank you so much. This was a fun conversation, as I knew it would be. I so appreciate, even as you said, the infrastructure back office side, having gone through my first fund audit, having had to build out a lot of these things in the last couple of years. I can so appreciate the very necessary, maybe not always feeling most as strategic, but critical, and just your patience and willingness to help in that area. I'm excited to find things for us to collaborate on. So glad we could come together on this conversation and look forward to doing more. So thank you again for joining.
Thanks, Gary. Really, really appreciate it.
Thank you for listening to this week's episode of Operate Podcast. If you like this conversation, as a favor to me, you can rate us, review us, or subscribe, or tell your friends. You can also reach out to us on Twitter at Operate Podcast. Until next week, get out there and operate.